Assalamualaikum and hi everyone. My name is Siti Shaira binti Amran, matric number 272988. I would like to present to you about the cash auditing. Do you know what is cash auditing? Cash auditing comprises of cash in hand, petty cash in the account and bank balance. Cash, it can be both an asset or liability for a business. If the entity has an overdraft account, then it will be recognized as a liability. When cash account is being audited, it is frequently known that cash is an inherently risk asset on the balance sheet. This is because cash can be misused without sufficient authorization, and cash transactions might result in the usage of the wrong account or the improper records timing. Let me explain to you about the transaction assertions. Occurrence means, did the transaction really occur during that particular period? Do the goods really go out to our customer? Did it really happen? Next, we have completeness. Completeness means, have we recorded all the transactions? Have not left some or excluded others? And then we have accuracy. Accuracy means, have we recorded every transaction accurately? Have we used the correct price, the correct quantity? Have we multiplied those to get the right amount? Next, we have cut-off. Cut-off is about the time frame, about the correct financial period. Okay, we usually record our transaction for the financial year ending in 6 months or 12 months. So we want to make sure that at the end of 31st December, we cut off every sales transaction. And then next we have presentation. Presentation is about how things look in the financial statement. Is everything recorded according to the accounting standards? And then last we have classification. Classification is all about making sure that we have debited the correct expenses, credited the correct revenue. It means that all items is recorded in the correct account. Next, we have balance assertions. Okay, the first one is existence. Existence means, is all the items in the balance sheet is real? Is it really exist? Okay, and then next we have right obligations. Do we own the asset to have the right to record it, or do we owe a liability and have obligations for that? And then we have completeness. Completeness is the idea that we have recorded everything. Is there anything missing or intentionally omitted? And then we have valuation and allocation. It is about the calculation of the number that we see on the balance sheet. Next, we have presentation. Presentation means that all the items in the financial statements match with the requirements of the accounting standards. And then last one is classification. Classification means that all the items in the balance sheet is sitting in the right category. Sitting in the right subcategory means that all the items are recorded in the right account. Okay, next part is the relevant control objective and control procedure. The first one is receipt record by post. Okay, the procedure that need to be done is to protect against mail interception between receipt and opening, and then next to appoint a supervisor to oversee the receipt postage, and then amount received through the mail are listed when post open. Next, we have recording of cash sales and collections. Cash can only be received by cashier or other appointed staff, and then issued a serially numbered receipt form as a proof of cash receipt. And then cash receipt or bank deposit slip must be in agreement. Next, we have general controls over recording. We need to update the cash book and ledger account as soon as possible, and then a pre-numbered receipt book that is blank must be kept safe. Next is banking. Okay, all cash and check receipt are banked on a daily basis, and then it is necessary to maintain control over cash disbursements. And then we have safeguard cash and bank accounts. Top authority must approve the opening of a new bank account. Cashier's cash floating should be kept to a minimum. Keep track of cash payments to avoid fraud, and then independent check on cash floats. Prepare monthly bank reconciliations and safeguards over check issue. Next, we have check payment. Okay, check requisitions must be accompanied by invoices, bills, or other supporting documentation and must be signed by a high authority. And then different people must be in charge of authority, custody, and recording. Then prompt dispatch of signed checks by payees. And then last one, we have cash payments. All cash expenditure must be authorized by senior official, and then limitations of cash advancements and disbursements. If controls are to be relied on, tests should be conducted to ensure their operational efficacy. This includes: first one is observe the mail's opening and check receipt, and then agree on a sample of cash deposited with payslips. Next, run a test to ensure that the bank reconciliation was completed on time and double-checked by senior official. And verify that the person authorizing the payment voucher is different from the person signing the checks. And last one, verify that cash payments are made by authorized individuals and are accompanied by documentation.
Assalamualaikum and morning everyone. My name is Huda, metric number 273131. Now, let's discuss more about the developing of audit procedures. There are several items that we need to understand before we do the auditing of the cash. So the first one is the bank transfer schedule. The second one is the bank reconciliation. The third one is the bank cut-off statement, and the last one is the bank confirmation. So let's move to the first item, bank transfer schedule. What is bank transfer schedule? Bank transfer schedule is actually used by the auditors to test for the existence of the kitting by the client. In bank transfer schedule, the withdrawal and the deposit date should have been recorded in the same reporting period. It is to avoid the double counting of cash. The schedule will list the detail of all transferred to and from the client banks, as well as it is between the client bank. We move to the second item, bank reconciliation. What is bank reconciliation? Bank reconciliation is a sum reports in the company's account are reviewed and reconciled with the balance shown in the organization accounting reports. If there are any difference in the company's account and the bank account in the financial statement, so the bank reconciliation needs to be made by the auditors. Bank reconciliation will help to detect any fraud and any cash manipulation by identifying the deposit in transit and the unpresented checks. Bank reconciliation are actually performed independently. Bank reconciliation will detect, first, whether all the client cash receipts have been deposited. Second is whether all the bank deposits have been recorded in the client accounting records in the correct period. Third is bank reconciliation will detect whether all the cash payment have been paid by the bank. Okay, the last one is bank reconciliation will detect whether all the bank payment have been recorded in the client accounting record in the correct period. I think that's all from me. I will let the next presenter to present about the bank cut-off statement and the bank confirmation. Thank you.
Hi, Assalamualaikum. My name is Rosmawa binti Asni, metric number 273095. First, I will present about bank cut-off statement. Bank cut-off statement is a client bank statement prepared Typically, the auditor requests that the client have the bank prepare a cut-off statement for a period of 10 to 15 days following the year end. The cut-off bank statement intends to validate the reconciliation element on the client's year-end reconciliation with proof that they do not have access to it. The verification is often to determine whether the document that come with the declaration have been removed, inserted or changed by the client employees. If a cut-off bank statement is not obtained directly from the bank, the auditor may validate the bank statement for the month following year end. Okay, next, so I will present about bank confirmation statement. What is bank confirmation statement? Bank confirmation statement is the auditor's audit procedure to test the existence, accuracy and ownership of the bank account and bank balance of the entity. Okay, so this procedure is normally performed during the interim audit rather than at the completion stage. However, if there is no interim, then it is performed at the final fieldwork, the same as other procedures. The bank confirmation is also used to gather any other information related to the bank account of the business. They may be used to confirm the closure of an account with a bank. Similarly, it can be used to request the bank for any accrued charges or accrued income on the bank accounts, such as interest, markup, and etc. that have not been yet debit or credit to the account. It also used to request for information related to any other facility that the bank may provide the business, such as loan, overdraft facilities, and etc. and they are detailed for disclosure purpose. The bank confirmation can also be used to confirm any contingent liabilities for this disclosure as well. Detail for disclosure purpose. The bank confirmation can also be used to confirm any contingent liabilities for this disclosure as well. Okay, next, why is bank confirmation is important? Bank confirmation are the most reliable type of audit evidence that auditors can obtain which regards to the existence, right and obligation, and valuation and allocation assertion regarding bank account balance in the financial statement. This is mainly because bank confirmation are recognized by the international standard on auditing as a more reliable form of audit evidence. The international standard on auditing as a more reliable form of audit evidence. Furthermore, according to ISA 500 audit evidence obtained from external independent source are more reliable as compared to audit evidence obtained from the management of the auditee business. Similarly, the standard suggests that audit evidence obtained directly by the auditor is more reliable as compared to audit evidence obtained through the involvement of the management of the business. The standard suggests that audit evidence in documented form is more reliable than audit evidence obtained verbally or orally. Finally, the standard also states that audit evidence obtained in original form is more reliable as compared to other forms, such as photocopies, film document, digitalized document, and etc. A bank confirmation meets all the criteria above from reliable information. It is sent by the bank directly to the auditor, thus making it direct form of evidence. Similarly, It is received in a written form, which made them a more reliable form of audit evidence as compared to evidence obtained orally or verbally. Finally, the evidence is obtained in its original form and not digitally or as a photocopy, thus making it better from the other form of audit evidence that are not obtained in their original form, such as contract or agreement. Bank confirmation is also important because they can be used to confirm other area of the financial statement, such as accrued interest, markup, and etc., and their relative changes in the statement of profit or loss. Similarly, it can also be used to confirm other facility that a bank provide to the business, which help confirm the disclosure within the financial statement. Disclosure can also be confirmed by inspecting the agreement or contract with the bank. However, bank confirmation will reflect the latest status of the agreement or contract. Next, what is the information that should be included in the letter? Okay. Although the auditee prepare the confirmation letter, the template is normally provided by the auditor. There is much information that need to be included in the letter, which is depending on the auditor's objective and requirement of each and individual's bank. When we prepare the bank confirmation letter, the three parties information need to be included in the letter. This include the bank that the letter will send to, auditee information, auditor information. That's all from me, so I will pass to the next presenter.
Assalamualaikum and welcome to all. My name is Muhammad Haikal, and in this topic, I will discuss about the fraud-related audit procedure. Okay, so let us explore what the fraud-related audit procedures mean. Okay, so the fraud-related audit procedures tell us how the auditor spends time evaluating the cash audit procedures. This is because to verify that there are no ambiguities and that any material misstatement caused by mistakes or fraud are identified early. So it showed that when the auditor suspects cash fraud or defalcation, the auditor determines that the client cash control is weak. Then when auditing the cash balance, the auditor must enter the expanded arena of procedures to detect fraud and be aware of the risk of fraud. Okay, so if the auditor believes that the client cash management has been weak and inadequate and that some fraud-related cash has occurred, they should use proof of cash as their audit procedures to detect fraud activities and to identify a large number of different cash-related errors. Okay, let's move to the meaning of proof of cash. So the cash proof is essentially a roll forward of each line item in a bank reconciliation from one accounting period with separate column for cash receipt and cash disbursement. As we can see, it gives more data and makes it easier to find errors and frauds than a bank reconciliation, even though it's difficult to perform than a bank reconciliation. Okay, now let's take a look at the purpose of proof of cash. First, it is to ensure all cash receipts recorded in the client's accounting record were deposited in the client's bank account. Number 2, to ensure all cash payments recorded in the client's accounting records have been cleared. Number 3, all recorded cash disbursement and all amounts that were paid by the bank were recorded. Number 4. No bank transaction have been omitted from the client's accounting record. But a cash theft cannot be identified by proof of cash if the cash was stolen before it was recorded in the client's record. If the auditor believes that cash was taken before it was recorded in the client's accounts, the audit procedures for testing the accuracy of cash receipts transaction should be performed. That's all from me. Then Kamarul will continue for the cash fraud related audit procedures.
Assalamualaikum warahmatullahi wabarakatuh. My name is Kamarul Ashraf bin Kamarul Zaman. My metric number is 272C52. So I will talk about test of lapping. Lapping is a defecation in which cash shortage is concealed by delaying the crediting of cash receipt to the proper account receivable. When an employee modifies account receivable record to conceal the cash embezzlement, this is known as lapping. This is accomplished by diverting payment from one client and then concealing the thief by diverting funds from another customer to offset the first customer receivable. Lapping can be discovered by reviewing cash receipt record on a regular basis and tracing payments back to the outstanding receivable. If there is proof that the cash receipts are being allocated to the wrong client's account on a regular basis, either the cashier is incredibly inept or there is an active lapping scam going on. Lapping usually necessitates the fraudster involvement every day, preventing him or her from taking vacation time. As a result, a person refusing to take their earned vacation time could be a sign of lapping. The following audit procedure would be used to uncover lapping. First, confirm account receivable. Paying special attention to client deviation to payment date. The confirmation technique is the best used as a surprise at later period, so that if someone is lapping, they will not be able to bring the lapper account up to date. If the confirmation are always prepared at the year end, the audit phase may be anticipated by the person doing the lapping, and the shortage may be discussed as a check kitting. The second is make a surprise count of the money and the check on hand. The money should be deposited under the supervision of the auditor, and the specifics of the deposit should be compared to the cash receipt book and the account receivable record subsequently. Third is compare the specifics of remittance list, stamped duplicate deposit slip, and cash receipt book entries. Due to the vulnerability of deposit slip, some auditors may duplicate deposit slip for deposit made a few days before and after the audit date, and have the bank authenticated the slip. The remittance list and cash book entry are compared to this certified duplicate deposit slip. Fourth is compare the check vouchers received with the client's checks, the entries in the cash book, and the posting to the account receivable record with a stamped duplicate deposit slip. The auditor should carefully compare the stamped dates to the dates entered in the cash receipt diary. If the client stamped the voucher with the day it was received. Next, I will talk about test of kiting. Kiting is a technique for hiding financial deficit from employees and auditors hiding bank overdraft from the concerned bank or banks, and padding a cash position. All crediting processes are designed to take advantage of the float period that occurs when the check is in transit from one bank to the next. A cash deficiency in a bank account can be masked by placing a transfer check drawn on another bank in the bank. The transfer check reconciles the bank account with the books of account even though it is not recorded as a deposit or a cash disbursement. Kiting is especially effective when an individual performs a reasonable number of typical check writing and deposit actions in account over a period of time, causing the account to appear entirely legitimate and thus be subject to the less bank-imposed restriction than a newly opened account. A kiting plan may involve in multiple banks in which some individuals shift check payments between multiple accounts on a regular basis in order to stay ahead from the fund clearing procedure. This can be a particular issue when a kiting scam is ultimately shut down, because depending on which check were issued from which account and the timing of the payment, one of the group banks may be stuck with the majority of the loss. Kiting might be uncovered by the following audit procedure. First, as a surprise count of cash and customers' check on hand is made as a test for the PIN, determine that check representing transfer of funds are properly recorded in the books. Second, prepare a schedule of interbank transfers for the day leading up to and including the audit date. The schedule should reflect the date that the cash disbursement was recorded on the books, as well as the dates of withdrawal and deposit as shown on the bank statement for each check. Third is cut-off bank statement covering the 7 to 10 days following the balance sheet date should be obtained directly from the bank. Examine the check returned with the cut-off statements, paying particular attention to the transaction dates marked on the back of the checks by the bank. This date should not be sooner than the check or cash disbursement dates on the books. Protest checks should be scrutinized to ensure they are not fraudulent checks deposited to offset a temporary shortage.
Hi, my name is Muhammad Izzat. Now, let us look further on the substantive procedures in cash auditing. Basically, there are three main procedures could be performed by the auditors in cash auditing, which are analytical procedures, substantive procedures for cash transactions, and substantive procedures for cash balances. For the first part, analytical procedures, since the cash has a volatile relationship with other financial statements accounts due to its residual character, the auditor's analytical procedures in auditing cash balances are limited to comparison with the previous year's balances and the budgeted amount, also by identify receipts for the next accounting period and review the long overdue checks to see if they should be recorded in the year-end balances. Next, for the second part is the substantive procedures for cash transaction. We will go through each session to see what is possible procedures could be performed by the auditors to assess the cash transactions. For the occurrence stations, it is really important for auditors to ensure that all the cash transactions reported are really occurred in the client's business operations during the financial period. The possible procedures are by selecting samples of cash receipts from the cash book and trace it to the remittance advisors, pay-in slips, and the bank statements. Auditors may also select samples of cash payment and trace it to the payment voucher with supporting documents or the bank statements. Other than that, auditor must also closely monitor the entries and trace any unusual items such as contra items, stop payment items, and cancel checks in order to verify the documentations and authorizations of cash transactions. Next, for the completeness assertions, it is important for auditors to ensure that the client's company completely record all transactions that happen in the business. The possible procedures are by tracing a sample of remittance advice and paid-in slip to the cash receipt journal, and trace a sample of cash payment vouchers to the cash book. For the accuracy assertions, auditor must agree the total of cash receipts and cash payment to the general ledger, and it is important to ensure that all the client's cash transaction has been recorded at the correct amount by testing the transaction related to the cash account. Next, for the valuation assertions, it is important for auditors to ensure that the cash transaction in the client's company has been valued correctly, which means that there is no understated or overstated amount in the cash transactions. Bank confirmations helps in valuations, and the possible procedures could be done is by confirming a sample of cancelled checks with the amount of cash recorded in the cash book. For the cut-off assertions, auditor must compare the dates of the cash transactions with the dates of the cash deposited in the bank. For the cash receipts, auditor may observe the cash counts for the last day of the year end and trace the deposit to the cash receipt journal and bank cut-off statements. Next, for classification assertions, auditor must examine the cash receipt and payment transaction for a proper classification. So generally, in cash auditing, testing the transaction details may include the cash cut-off test and tracing bank transfer, considering that clients make attempts to manipulate their accounting transactions. Next, for the last part, is about the substantive procedures for cash balances. For the existence and completeness assertions, the possible procedures are by identify and send bank confirmation letters to all of the client's bank. An auditor must confirm the cash balance on the bank confirmations and bank reconciliations to the cash book and financial statement. Auditors must also check further on the deposit in transit, outstanding checks, and other reconciling items to the cut-off bank statements. Next, for the accuracy and valuation assertions, the possible procedures are by review the bank reconciliations and check subsequent clearance of unpresented checks and uncredited lodgements. An auditor must agree any unpresented lodgement with bank statements after the end of the year, and auditor must check whether the cash and bank balances are recorded at an appropriate amount. For classification, presentation, and disclosure assertions, auditor must review Board of Directors minute, bank letters, loan agreement, or other documents for any restriction for cash. It is important to ensure that the bank loans and overdraft are not offset against the positive bank balances in the financial statements, and auditors must ensure that cash and bank balances have been recorded and classified properly. Next, for the rights and obligation assertions, it is important to make sure that the client's company owns the bank account or the cash, which means that the company has control over the account by examining whether the entities hold the right over the cash and bank balances. So generally, there are several procedures could be performed by the auditors to test the cash and bank balances. The first one is by verifying the bank reconciliations. This testing is conducted to verify that the bank confirmed balances match the balances in client's record. The first step is verify the bank reconciliations mathematical accuracy and agree on the cash book balance. Second, compare the bank reconciliation balance with the bank confirmation balance. Third, the bank reconciliations trace the deposit in transit to the cut-off bank statements for a week after the bank account is reconciled. Next, agree to the bank reconciliations any costs mentioned in the bank statements. And the fifth, agree the adjusted book balance on the cash account late schedule. After that, trace bank transfer for last week of financial year under review and first week of the financial year for the proper cut-off. And last, identify irregular or unusual items and obtain necessary explanations. Next, the other procedures could be performed is by confirming the bank balances and other arrangements. Auditors may send a bank confirmation request to the bank directly, and the request is for information on the bank balances or other financial arrangements like overdraft and credit facilities. Auditors can also get information on the third-party loan guarantees and unused facilities. This information is necessary for both disclosure and determining unrecorded obligations. Last is about counting cash in hand. To conduct a proper cash count, the auditors should keep all cash and negotiable items under his or her control until all funds has been counted. The control of all money is intended to prevent counted funds from being transferred to uncounted funds by entity personnel. When cash is housed in multiple locations, it is necessary to seal funds and hire additional auditors. Except for disclosures, this approach offers evidence for each of the financial statements assertions. However, companies often attempt to keep cash on hand to a minimum, which makes the amount is insignificant. I think that's all from us. Thank you.